What do you get when one of the world's most powerful banks quietly accumulates enough silver to rival the strategic reserves of entire nations? You get a powder keg sitting in plain sight while everyone's looking the other way. We're talking about JPMorgan Chase and the roughly 169 million ounces of physical silver they've been stacking for over a decade. To put that in perspective, that's more silver than most countries hold in their vaults, and it represents about 15% of total annual global mine production, just sitting under one institution's control. Think about that for a moment. One bank, 169 million ounces. That's not a trading position. That's a strategic stockpile. Here's where it gets interesting. This isn't some conspiracy theory cooked up in a Reddit forum. We're looking at documented vault holdings, Comex warehouse reports, and a paper trail that runs through some of the most dramatic moments in modern financial history. JP Morgan didn't wake up one day and decide to become America's silver baron. They inherited a massive bullion infrastructure through crisis-era acquisitions, then systematically built upon it while the rest of the market wasn't paying attention. The story starts in March 2008, when Bear Stearns collapsed during the financial crisis. You remember that weekend, right? When our government orchestrated an emergency takeover to prevent a complete meltdown of the financial system, well, JP Morgan didn't just acquire Bear Stearns' investment banking operations and their troubled mortgage portfolio. They also inherited something far more tangible and far more valuable in the long run: Bear Stearns' entire precious metals operation, including their massive Comex vault facilities and existing bullion positions. But that was just the beginning. Over the next several years, as the dust settled from the financial crisis, JP Morgan made a calculated decision. While other banks were retreating from commodities and reducing their physical holdings, JP Morgan went the opposite direction. They became the largest custodian of silver on the Comex exchange, the primary venue for silver trading in North America. Their vaults in New York became the single biggest storage point for physical silver in the entire Western Hemisphere. Now here's what should grab your attention. This accumulation didn't happen through normal market purchases that would have driven prices up and attracted attention. Instead, JP Morgan used their unique position as a clearing bank and vault operator to quietly take delivery of physical metal through the futures market, systematically converting paper contracts into real bars sitting in their own warehouse. According to delivery data from the Comex that anyone can access, one house account repeatedly stood on the other side of the market, taking delivery when everyone else was selling paper. Let me paint you a picture of what 169 million ounces actually looks like. If you stacked those standard 1,000-ounce silver bars, you'd need about 6 full-size Olympic swimming pools to hold them all. In dollar terms, at current prices, we're talking about a hoard worth somewhere between $4 and $5 billion. That's a position large enough to move markets, large enough to influence global supply chains, and large enough to make a lot of people very uncomfortable once they realize the implications. But here's the twist that makes this story truly remarkable and deeply ironic. This is the same institution that paid nearly $1 billion in fines to the Department of Justice and the Commodity Futures Trading Commission for manipulating precious metals markets. Yes, you heard that right. JP Morgan admitted to years of spoofing in gold and silver futures, a practice where traders place and quickly cancel large orders to manipulate prices. The DOJ case revealed internal chat logs where traders openly discussed their strategies for painting the tape and moving the market in their favor. Think about the audacity of this for a second. You spend years using derivatives and futures contracts to suppress the price of silver, paying massive fines when you get caught, and all the while, you're accumulating the largest physical hoard of that same metal in the Western world. It's like being convicted of insider trading while quietly buying up every share of the stock you were manipulating. The entity caught holding prices down is now the one positioned to profit most dramatically when those prices inevitably explode. And explosion is exactly what the fundamentals are pointing toward. Because while JP Morgan was building this fortress of silver, something critical was happening in the physical market. The global supply-demand picture for silver was fundamentally changing in ways that make this stockpile increasingly valuable and increasingly powerful. Here's what most people don't realize. Silver isn't just money or jewelry anymore. Over the past decade, silver has become an absolutely critical industrial commodity. Every solar panel installation requires silver for electrical conductivity, about 1 ounce per panel on average. And with solar deployments accelerating globally, that's enormous demand growth. Electric vehicles use more silver than traditional cars because of increased electronic components and electrical systems. 5G infrastructure, medical equipment, water purification, electronics, all of them rely on silver's unique properties that no substitute can fully replace. According to the Silver Institute, industrial demand now represents roughly 60% of total annual silver consumption, and it's growing faster than mine supply can keep pace. We're not talking about marginal increases here. We're talking about structural demand growth that's baked into every major government's energy transition, plans, and technology roadmaps. China alone is installing more solar capacity in a single year than most countries have installed in their entire history. And every single panel needs silver. Meanwhile, on the supply side, we've got a problem. Global silver mine production has been essentially flat for years, hovering around 830 to 850 million ounces annually. Why? Because silver is rarely mined on its own. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So, when base metal prices are weak, or when mining projects face delays and permitting challenges, silver supply doesn't respond to rising demand the way simple economics suggests it should. You can't just turn on more silver production the way you might drill another oil well. This creates what analysts call a structural deficit, where annual demand exceeds annual supply, and the gap has to be filled by drawing down existing stockpiles. The Silver Institute's data shows we've been running these deficits for multiple consecutive years. Above-ground inventories, the silver sitting in vaults and available for industrial use or investment, have been steadily declining. Look at what's happened to silver ETF holdings, which serve as a barometer for readily accessible investment-grade silver. After hitting record highs in 2020 and 2021, those holdings have been drawn down as investors sold, and as industrial users desperately sourced metal to meet their production needs. Comex warehouse stocks, the registered and eligible silver available for delivery against futures contracts, have also been declining from their peaks. Refiners are reporting something even more telling. The large refineries that process silver into industrial-grade forms or investment bars are having increasing difficulty sourcing 1,000-ounce good delivery bars, the standard form traded on the Comex and used by institutional players. When refiners struggle to find feedstock, that's a red flag that the physical market is tighter than the paper price suggests. Now let's connect these dots. You've got surging industrial demand driven by megatrends that aren't going away. You've got stagnant mine supply that can't respond quickly. You've got declining above-ground inventories as existing stockpiles get consumed. And sitting right in the middle of this increasingly tight market, you've got JPMorgan holding roughly 169 million ounces, a quantity that represents nearly 20% of total annual demand, or about 6 months of global industrial consumption. What does this mean? It means JPMorgan isn't just a large holder of silver. They're sitting on a choke point in a market that's already struggling to balance supply and demand. Every ounce that's locked away in their vault is an ounce that's not available to balance the market. It's an ounce that industrial users can't access, that other investors can't buy, that mints can't turn into coins. Think about what happens in any market when a dominant player controls a large percentage of a scarce resource. They don't have to actively manipulate anything. Their mere presence changes the dynamics. Other participants have to bid higher to secure a supply. Price discovery becomes less about fundamental supply and demand, and more about whether the dominant holder decides to release material or hold it back. And here's the final piece that should make you sit up and pay attention. Silver is one of the few remaining commodity markets where the total size of the market is actually quite small compared to global financial flows. The entire world's annual mine production is worth maybe $25 to $30 billion at current prices. That's less than the market cap of many individual tech companies. It's a rounding error in global currency markets that see trillions of dollars of daily trading volume. What happens when even a small percentage of global investment capital decides to allocate to physical silver as a hedge against currency debasement or financial instability? What happens when other institutions or countries start thinking strategically about securing critical industrial metals? The market simply cannot absorb that kind of demand without explosive price moves, and the institution sitting on the largest stockpile gets to watch their net worth multiply, while everyone else scrambles for scraps. JPMorgan spent over a decade accumulating this position, while silver prices remained relatively subdued. They took advantage of market apathy, regulatory settlements, and their unique infrastructure to build what amounts to a silver fortress. And now, as the fundamental picture tightens and as the catalysts for higher prices begin to align, they're positioned like no one else in history has ever been positioned in this market. The question isn't whether this stockpile matters. The question is, what happens when the market finally wakes up to the reality that 169 million ounces, a significant fraction of the world's readily available silver, sits under the control of a single institution that has every incentive to see prices move dramatically higher? That's not a theory. That's just math and market structure. And the clock is already ticking. Now let's talk about how we actually know JPMorgan is sitting on this mountain of silver, because extraordinary claims require extraordinary evidence. And the evidence here isn't coming from anonymous sources or leaked documents. It's hiding in plain sight in publicly available data that most people simply never bother to examine. The Comex, officially the Commodity Exchange Division of the New York Mercantile Exchange, publishes daily warehouse reports that show exactly how much silver sits in approved vaults and who the vault operators are. These reports break the holdings into two categories: registered silver, which is available for delivery against futures contracts and comes with specific warrants, and eligible silver, which meets quality standards but isn't currently pledged for delivery. When you track these reports over time and cross-reference them with delivery data, a pattern emerges that's impossible to ignore. One vault operator consistently shows up as holding vastly more metal than any competitor. We're talking about a facility that at various points has held over 50% of all the registered silver on the entire Comex exchange. When you dig into corporate filings and cross-reference vault addresses with known JPMorgan facilities, the picture becomes crystal clear. The bank's vault at One Chase Manhattan Plaza in New York became the epicenter of physical silver in North America. But here's where it gets really interesting. Those warehouse reports only show what's sitting in Comex vaults at any given moment. They don't show the cumulative flow of metal that's been delivered and potentially moved to other storage locations. Think about it. If you're building a long-term strategic position, do you keep everything in the exchange warehouse where it shows up in public reports? Or do you take delivery, transfer the metal to private storage, and keep accumulating? Independent precious metals analysts, including some who've spent decades tracking these markets, have documented the delivery patterns. According to their research synthesizing years of Comex delivery data, JPMorgan's house account took delivery of massive quantities of physical silver, particularly during the period from 2011 to 2020. We're talking about months where a single account would stand for delivery of 2, 3, or even 4 million ounces, while the rest of the market was rolling contracts forward or settling in cash. Month after month, year after year, the same pattern repeated. Ted Butler, a precious metals analyst who's been following silver markets for over 30 years, has extensively documented this accumulation. His analysis of the Bank Participation Report, another public document published by the CFTC showing the aggregate positions of U.S. and foreign banks in futures markets, revealed that during the very period when JPMorgan was building this physical hoard, they were also holding enormous short positions in silver futures. You see the strategy now? Short the paper market to keep prices suppressed, while you're accumulating physical metal at artificially low prices. It's brilliant in its audacity and borderline criminal in its execution. Which brings us to the legal record, because this isn't speculation about market manipulation, it's established fact that resulted in some of the largest regulatory penalties in commodity market history. In September 2020, JPMorgan agreed to pay $920 million to settle charges brought by the Department of Justice and the Commodity Futures Trading Commission. These weren't minor technical violations. The government's case documented a systematic scheme of spoofing and manipulation in precious metals futures that ran for nearly a decade. Let's be clear about what spoofing actually means. Traders place large orders to buy or sell futures contracts with no intention of executing those trades. The goal is to create a false impression of market demand or supply, trick other traders into reacting, and then cancel the fake orders while taking advantage of the price movement they just created. It's the electronic equivalent of yelling "fire" in a crowded theater to stampede people in a direction that benefits you. The Justice Department's evidence was damning. They had chat logs where JPMorgan traders openly discussed their spoofing strategies. In one message, a trader described how they would defend the fix in gold and silver markets, meaning they would use spoofing techniques to suppress prices during the London fix, the benchmark price-setting mechanism that influences global precious metals markets. Another trader bragged about being able to move the market a buck with their orders. These weren't rogue employees. The government identified multiple traders across several years who engaged in these practices. Here's what makes this particularly egregious. The manipulation conviction came after years of complaints from smaller traders and market participants who insisted something wasn't right about how silver traded. When silver would rally, massive sell orders would suddenly appear, knock the price down, then disappear. This happened so consistently that pattern recognition algorithms could identify it. Yet for years, regulators either didn't see it or didn't act on it. The settlement included an admission by JPMorgan that the conduct violated the Commodity Exchange Act. The $920 million penalty included $436 million in criminal fines and forfeiture, $311 million in civil penalties to the CFTC, and restitution to affected parties. For context, that's one of the 10 largest commodity trading penalties ever assessed by U.S. authorities. But here's the truly remarkable part about the timing. The bulk of JPMorgan's spoofing activity, according to the government's charging documents, ran from 2008 to 2016. That overlaps almost perfectly with the period when they were building their physical silver position through Comex deliveries. So while they were paying traders to manipulate the paper market and suppress prices, they were simultaneously accumulating physical metal at those artificially low prices. By the time the settlement was announced in 2020, the accumulation was essentially complete. The manipulation chapter was closed with a financial penalty that amounted to a cost of doing business, and JPMorgan emerged holding a strategic stockpile that had just appreciated in value far more than the fines they paid. Think about the game theory here. You spend maybe $100 million in various costs related to the manipulation scheme, trader bonuses, legal fees, and eventually the fine. But by keeping silver prices suppressed for years, while you accumulate 169 million ounces, you potentially saved billions of dollars compared to what you would have paid if your buying had driven prices up naturally. Then, once you've finished accumulating, you settle the case, pay the penalty, and sit on a position that will benefit massively from the very price appreciation you were previously suppressing. Now let's connect this to what's happening in the physical silver market, because the accumulation story only matters if the underlying fundamentals support a squeeze scenario. And the fundamentals right now are screaming that this market is tighter than a drum. Start with mine supply. According to the Silver Institute's World Silver Survey, global mine production reached about 843 million ounces in 2023. That number has been essentially flat since 2016, bouncing between 820 and 850 million ounces, depending on the year. This isn't because silver is getting harder to find. It's because of how silver gets produced. Nearly 3/4 of mined silver comes as a byproduct of extracting other metals. When you're mining copper in Peru, lead and zinc in Australia, or gold in Mexico, silver often comes along for the ride. This creates a fundamental constraint. Even if silver prices doubled or tripled, you wouldn't see a flood of new primary silver mines because the economics of most silver deposits don't support standalone operations. And the base metals that produce silver as a byproduct, their production. Decisions are driven by copper prices, zinc prices, and lead prices, not silver. So, supply is relatively inelastic, meaning it doesn't respond much to price changes in the short to medium term. On the demand side, we're seeing structural growth that's only accelerating. Industrial fabrication demand hit a record 539 million ounces in 2023, according to the Silver Institute. Photovoltaic solar panel production alone consumed nearly 185 million ounces, up more than 20% from the previous year, Every time a government announces a new clean energy initiative or raises their solar installation targets, that's more silver that will be consumed and is essentially gone forever from the investment pool because it's very difficult to economically recover silver from installed solar panels or electronic devices. The automotive sector is another major growth driver. According to the Silver Institute, each electric vehicle uses roughly twice as much silver as a traditional internal combustion engine vehicle, about 1 to 2 ounces per EV compared to 0.5 to 0.7 ounces for conventional cars. With EV sales growing globally and governments mandating the phase-out of gas-powered vehicles, we're looking at tens of millions of additional ounces of demand in the coming years just from this single sector. Put it all together, mine supply essentially flat at 843 million ounces, industrial demand at 539 million ounces, and growing jewelry and silverware adding another 200 million ounces, and investment demand fluctuating but historically averaging 150 to 300 million ounces. The math says we're consuming more silver than we're mining, and the gap has been filled by drawing down existing stockpiles. The above-ground inventories held in ETFs, bank vaults, and exchange warehouses. Look at what happened to silver ETF holdings as a clear indicator. The largest silver ETF, the iShares Silver Trust, held over 635 million ounces at its peak in 2021. By late 2023, that had dropped below 450 million ounces. Where did nearly 200 million ounces go? Much of it was sold by investors who got bored with silver's sideways price action and rotated into other assets. But a significant portion was also pulled by industrial users desperately trying to source physical metal to meet their production needs. When you're a solar panel manufacturer and you need silver, you'll pay up to get it, even if that means buying ETF shares and redeeming them for physical bars. The same drain is visible in Comex warehouse stocks. Registered silver on the Comex, the metal available for immediate delivery against futures contracts, has been on a downward trend from its highs. Some months see dramatic draws as industrial players take delivery. Some analysts tracking these flows point out that we're increasingly seeing delivery stress, where more contracts stand for delivery than the exchange has readily available registered silver to fulfill without scrambling. Refiners are telling the same story from a different angle. The Swiss refineries that process much of the world's silver, companies like Metalor and PAMP, have publicly discussed how difficult it's become to source 1,000-ounce good delivery bars, the standard wholesale form. These bars are what institutional players trade, what gets delivered on the Comex, what central banks hold. When the world's top refiners say they're having trouble sourcing feedstock, that's not a minor supply hiccup. That's evidence of deep structural tightness in the wholesale physical market. Now, overlay JPMorgan's 169 million ounces on this picture. That's roughly 20% of annual global mine production. It's equivalent to about 1/3 of total annual industrial demand. It's more silver than has been drained from all silver ETFs over the past 3 years combined. And it's sitting inactive in vaults controlled by a single institution that has zero incentive to release it into a tight market at current prices. Here's the key insight. JPMorgan doesn't need to actively manipulate anything at this point. Their mere presence as the dominant physical holder changes the market structure. When industrial users need large quantities of silver, they can't assume it's readily available. They have to compete more aggressively for whatever supply remains outside JPMorgan's control. When other investors decide they want physical exposure, they're fishing in a pool that's already been partially drained. When another institution wants to build a position, they face the reality that the easiest accumulation opportunity has already been taken. This is what market dominance looks like. It's not about cornering 100% of supply. It's about controlling enough of a scarce resource that you fundamentally alter the supply-demand dynamics for everyone else. The Hunt brothers tried to corner silver in 1980 with an estimated 100 million ounces before regulators changed the rules and crushed them. JPMorgan has assembled an even larger hoard, but they did it slowly, methodically, through regulated exchanges and approved warehouses, all while maintaining their status as a too-big-to-fail, systemically important bank. The irony is almost poetic. The institution caught manipulating silver prices downward is now positioned to benefit more than anyone else when those prices inevitably have to rise to clear the structural supply deficit. They paid their fine, closed the manipulation chapter, and emerged holding a position that could potentially generate tens of billions of dollars in profit as the physical market fundamentals finally overwhelm the paper trading dynamics that kept prices suppressed for so long. The evidence isn't hidden. It's in the Comex data, the legal settlements, the supply-demand reports, and the increasingly desperate scramble for physical metal that refiners and industrial users are experiencing. JPMorgan built a silver fortress in plain sight, and now they're sitting behind those walls while the market outside grows tighter by the day. The only question left is what happens when the pressure becomes too great and something has to give. Let's run the numbers on what a genuine silver squeeze would actually look like, because this isn't some abstract possibility. It's a mathematical inevitability that becomes clearer once you understand the scale mismatch between available supply and potential demand. Start with the baseline reality. Global mine production runs about 843 million ounces annually. Industrial demand alone consumes 539 million ounces of that, and it's growing. Jewelry and silverware take another 200 million ounces. That leaves roughly 100 million ounces available for investment demand before you even account for government mints producing coins or small retail demand. Now remember, JPMorgan is sitting on 169 million ounces. That's not 1 year of investment available supply. That's nearly 2 years of the entire world's marginal silver, the metal that's available after industrial users take what they need. Here's where the math gets explosive. Investment demand isn't some stable, predictable number. It swings wildly based on market sentiment, inflation fears, and financial uncertainty. In 2020, during the early stages of the pandemic and massive monetary stimulus, investment demand for silver surged to over 300 million ounces, according to the Silver Institute. In 2021, amid the Reddit-fueled excitement and continued uncertainty, it remained elevated. When investor appetite for silver rises, whether from inflation fears, currency concerns, or simply momentum trading, the entire available supply gets absorbed almost immediately because there's no cushion, no extra inventory waiting on the sidelines. Now, think about what happens if JPMorgan decides their stockpile is worth more than current market prices. They don't need to sell a single ounce to influence the market. In fact, their power comes from not selling. Every ounce locked in their vaults is an ounce that's not available to satisfy surging investor demand or desperate industrial users. It's like owning 20% of the tickets to the most popular concert of the year and simply not releasing them. What happens to the price of the remaining tickets? They skyrocket. The beauty of JPMorgan's position is that they win no matter what they choose to do. If they hold the metal off the market as demand surges, prices rise and their unrealized gains multiply. If they eventually decide to sell strategically into that higher price environment, they can realize those gains while still maintaining a dominant position. And unlike the Hunt brothers in 1980, JPMorgan isn't using massive leverage or making themselves vulnerable to margin calls. They own the physical metal outright in their own vaults. Let's talk about those historical silver manias, because they're not ancient history. They're templates for understanding how violent silver moves can be when supply-demand dynamics break. The Hunt brothers' attempted corner peaked in January 1980 when silver briefly touched $50 per ounce, up from around $6 just a year earlier. That's an 8-fold increase in 12 months. The Hunts were accumulating maybe 100 million ounces of silver and using massive amounts of leverage through futures contracts. When regulators changed the margin requirements and restricted trading, their empire collapsed almost overnight and silver crashed back down. But here's what's different about our current situation. The Hunt brothers were trying to create artificial scarcity in a market that actually had plenty of supply. Mine production in 1980 was robust. Above-ground stocks were abundant, and industrial demand was relatively modest. They were fighting the fundamentals, and fundamentals eventually win. JPMorgan, on the other hand, is positioned in alignment with the fundamentals. They accumulated their hoard during a period of actual structural deficits. The scarcity isn't artificial, it's real, driven by growing industrial demand that can't be easily shut off, and mine supply that can't quickly expand. The 2011 silver rally offers another instructive case study. Silver ran from around $18 in August 2010 to nearly $49 in April 2011, almost a triple in 8 months. What drove that move? A combination of factors: quantitative easing from the Federal Reserve creating inflation fears, sovereign debt concerns in Europe making investors seek alternative stores of value, and growing awareness of silver's industrial applications, particularly in green energy technologies. But here's the crucial point. That rally happened when above-ground inventories were still relatively abundant, and before the massive industrial demand growth from solar and EVs really kicked into high gear. Now, fast forward to today. We're starting from a position of tighter physical fundamentals than 2011, lower above-ground inventories than 2011, stronger industrial demand growth than 2011, and with JPMorgan controlling a concentrated hoard that didn't exist in 2011. If the same macroeconomic catalysts that drove silver to $49 in 2011 were to reappear today, the price response would likely be far more explosive because there's simply less available silver to satisfy that surge in demand. Let me paint you a realistic scenario for how we get to that 500% squeeze number. Silver currently trades in the mid-20s per ounce. A move to $125 to $130 represents roughly a 5 times increase from current levels. Is that outlandish? Not when you consider that silver hit $50 twice in the past 45 years, starting from much lower bases and with better supply fundamentals. But let's be conservative and think about what needs to happen. First catalyst: Federal Reserve policy. After raising interest rates aggressively to fight inflation, the Fed has signaled they're done with hikes and will eventually need to cut rates as the economy weakens. When rates come down while government deficits remain enormous, that's classic conditions for dollar weakness and inflation concerns. Investors flee into hard assets. Silver, with its dual monetary and industrial characteristics, becomes extremely attractive. Second catalyst: the ongoing energy transition. Governments around the world have committed to ambitious carbon reduction targets. The European Union's Green Deal, America's Inflation Reduction Act, China's solar installations, all of these represent locked-in demand for silver that's growing every year. According to industry projections, solar panel installations could consume 250 to 300 million ounces annually by 2025, up from 185 million in 2023. That's an additional 65 to 115 million ounces of structural demand, hitting a market that's already struggling to balance. Third catalyst: currency and geopolitical tensions. As we've seen with de-dollarization trends and nations seeking alternatives to dollar reserves, precious metals become strategic assets. If even a handful of central banks or sovereign wealth funds decide they want meaningful silver positions as part of their strategic metal reserves, they're trying to buy in a market where one American bank already controls nearly 170 million ounces, and the remaining readily available supply is scarce. Fourth catalyst: the derivatives unwind. The silver futures market has always had a massive short position, held by large commercial traders. As physical tightness increases and delivery pressures mount, those shorts become increasingly dangerous to maintain. If we see a wave of short covering as traders realize they can't deliver physical metal against their paper contracts, that buying pressure amplifies any upward price move. It's a feedback loop where higher prices trigger more short covering, which drives prices even higher. Here's the timeline that matters. We're likely already in the early stages of this process. Silver's ratio to gold, how many ounces of silver it takes to buy 1 ounce of gold, currently sits around 85 to 1. Historically, that ratio has averaged closer to 60 to 1, and during periods of silver outperformance, it's compressed to 30 to 1 or even lower. Mean reversion alone suggests significant upside for silver relative to gold, and when you layer in the industrial demand growth and the supply constraints, the case for outperformance becomes overwhelming. Over the next 12 to 24 months, watch for these signposts. If the Fed begins cutting rates, while inflation remains sticky, that's your first signal. If Comex registered silver inventories continue to decline and delivery stress increases, that's your second signal. If we see large ETF inflows as investors pile back into silver, that's your third signal. And if you start seeing industrial users publicly discussing supply concerns or entering into long-term contracts at premium prices to secure future supply, that's your confirmation that the physical market has fundamentally broken. JPMorgan doesn't need to do anything to profit from this scenario. They just need to sit tight and let market forces do the work. Every month that goes by, with continued industrial demand, growth and constrained supply adds pressure to a coiled spring. Every incremental ounce of investor demand has to compete for a shrinking pool of available metal. Every dollar of new investment capital that decides to allocate to silver arrives in a market where the biggest, easiest to acquire hoard is locked up and off limits. Think about the positioning aspect from an individual investor's perspective. Most people have the bulk of their wealth in paper assets, stocks, bonds, real estate, maybe some cryptocurrencies. Very few Americans hold any meaningful allocation to physical silver. When was the last time you heard a financial advisor recommend that clients hold silver bars or coins as part of their portfolio? It's considered a fringe investment, something for preppers and conspiracy theorists, not serious investors. But what if that conventional wisdom is about to be proven catastrophically wrong? What if the combination of industrial demand, monetary debasement, and concentrated supply control creates a perfect storm that makes silver one of the most important wealth preservation assets of this decade? The people positioned ahead of that realization will see substantial gains. The people who wait until silver is making headlines at $75 or $100 per ounce will pay a much higher price for much scarcer metal. Here's the empowering conclusion. This isn't about fear or panic. This is about understanding structural imbalances in a critical market before those imbalances become obvious to everyone. JPMorgan spent over a decade quietly positioning for this outcome. They did their homework, accumulated methodically, and now sit behind a fortress of physical metal while the market outside grows tighter by the quarter. You don't need to match their 169 million ounce hoard to benefit from the same understanding. What you need is awareness of the forces in motion, the supply deficits, the demand growth, the monetary pressures, and the concentration of control. Those forces are still building, still early in their trajectory. The 500% squeeze isn't some distant possibility that might happen if everything goes perfectly. It's a process that's already begun, visible in the falling inventories, the rising industrial demand, and the refiner reports of sourcing difficulties. The market still thinks silver is boring. The financial media treats it as a footnote compared to gold or Bitcoin or tech stocks. And that's exactly what creates the opportunity. By the time silver becomes exciting again, by the time it's breaking out to new highs and analysts are scrambling to explain why, JPMorgan will have already won, and the window for accumulating physical metal at reasonable prices will have closed. The math is clear, the fundamentals are undeniable, the historical precedents exist, and the institution with the deepest insight into this market has already voted with billions of dollars by building the largest private silver hoard in the Western world. The only question that matters is whether you understand what they understand before the rest of the market figures it out.